Hello everyone and welcome to another one of our knowledge transfer series. Today what we're going to do is talk about understanding the taxes when you sell your primary home. I tend to work a lot with retirees or soon to be retirees, and one of the things that naturally happens at this phase in someone's life is people oftentimes will sell the home they've lived in for a very long time. They might be moving next to family who's moved away, like kids. They might be downsizing because the house they've lived in forever is just too big or too much to maintain for them. There's lots of reasons that people sell at this age, but it's pretty common. And because this is common, a lot of the times people get paralyzed around the math around selling their home because they don't know what they can do, because they don't know what they're going to get. Okay, so I thought this video would be good to create of just kind of walking through the basics of taxation when you sell your home, right? One of those nice sleep at night, put you to sleep easy at night videos. Now, when we talk about taxes, everyone's tax situation can be different. I don't file people's taxes. I generally do, tax planning. And so, we have to treat today's information as general in nature. This is not designed to let you precisely file your taxes. It's designed to give you really good information to go through this process. Now, my name is John Erickson. I have more than 17 years experience in the financial services industry. I'm a graduate of Washington State University, and I tend to work with retirees or soon-to-be retirees. So this is a topic that I run into a lot. So I've had to talk people through this a lot, basically. And when I talk people through this, I start with the keep it simple, stupid method, or the KISS method. Okay, just let's do a basic sandbox calculation. But then we have to dive into the more precise number, which means you have to understand basis and gains, you have to understand capital gains taxes, and then net investment taxes. So we'll walk you through each of these little concepts. But if we're trying to keep it simple, right? Keep it simple, stupid. Then it's pretty easy. And if I was to summarize this most simply, I'd say until your gain is more than $250,000 or $500,000 if you're a couple and married, your spouses, you don't have to worry too much about federal taxes. You need to be bigger than these numbers. Now, I live in the Western Washington state, and we've had housing prices that have exploded. And because of that, we're having to worry about this more and more. And so if we're going to keep it simple, you take what you're selling something for, and if you don't know, go Zillow or Redfin and get an estimate. You subtract what you bought it for, ignore the mortgage. I've had people ask me about the mortgage. Ignore that for now. You're subtracting what you bought it for, then subtract an additional $250,000 per person, and that's your keep it simple method. And so, in this example here, you might have a situation where the gain is zero because they're a couple. Or in this example, I have one person. So you take $1 million, subtract your purchase $500,000, subtract $250,000. Your gain is $250,000. You multiply it by 20%, which is a little high, but I can get to that later. But that's a good starting point for federal taxes. And you have your basic sandbox number that says you're going to pay about $50,000 in federal taxes. So that's a very simple calculation. I can do this quickly with most people. It lets me kind of create my initial, okay, this is what your decision points are. Down the road, we need to fine tune it. And when we fine tune it, we need to talk about some basic concepts. And once again, this isn't too hard. Just work, which, how much time do we all have in our life? But when we talk about how do you worry about taxation and sell your home? We're going to look at federal here primarily. The IRS has a great publication, 523. And they've had a lot of the common situations in this publication. They've dealt with a lot of the taxation around selling someone's home because they want to collect the tax money. And what they'll show you is that you take your selling price, you subtract selling expenses from it, you subtract something called adjusted basis from it, and that's how you figure out what your gain is. You can actually have a loss, and this time we're going to primarily look at gains. Then you look at your maximum exclusion, and to use a maximum exclusion, you have to have lived in this place as your primary residence 2 of the last 5 years. Based upon your filing status, you get to have either $250,000 or $500,000 of exclusion from that above number. So I'm going to take a couple's exclusion, married filing jointly. And that means a taxable gain in the situation is $250,000. But, there's a lot of terms I used in that previous example here. And let's talk about basis first. Basis is one of those ones that can be a little bit more complicated. And if you can figure out the basis, the rest of the math is a lot easier. So basis is what you bought something for or had it gifted to you as an amount, as another example. Then you get to add in improvements to your home. And improvements aren't repairs, like painting because your painting is falling down isn't a repair. But painting, because you are putting a deck on there and you're putting new siding on there and you paint it as part of a big project, that could potentially be adding to your basis. Okay? And so, you get to add in improvements. Better have your receipts. I always tell people it doesn't count if you don't have documentation. And that improves your basis. So if you bought something for $250,000, but you put a deck on there and did a whole bunch of work, and you get to add an extra $50,000 on there, your basis actually goes up to $300,000. That's how much you can deduct from the taxation calculation. But there's some other common scenarios that affect your basis that you have to recognize, and this is something you can use as a tool as well. Spouses. So my wife and I are married. We live in a community property state, and if we live in our house forever, and someday I'll probably die first because of my age and my gender, she's going to inherit the house from me. And when she inherits the house from me, she gets a step up in basis right there on that spot. And that's because we're a community property state. Other states, you have to follow different rules or set up specific situations for yourself. But in Washington State, we get the step up in basis. And so when you inherit a piece of property, you get to wipe out a whole bunch of the past gains because you inherit it at its current value. And that's what your new basis is. And when a couple, like sometimes I'm looking at situations in financial planning where people are aging and they may want to keep their primary home because one of them may pass because they might be in hospice or something, and I know they're going to get the step up in basis. And then once that person passes, the spouse can now sell that property for practically no federal taxation. We have the post-84 divorce rules that also affect your basis positively. Some things that don't affect your basis: if you gift your home, like you gift your home to a kid or a trust, that makes it so you don't get the step up in basis anymore. That's a problem with trusts, actually. And then things that can screw up your basis or make the calculation harder. And when you start to use your property, personal property as a rental property, as well as personal property, and or use business use on your personal property, that has very special rules that adjust your basis. And once again, the IRS publication talks about that. Real estate commissions. A lot of people will use, or compensation as it's now called. A lot of people will use real estate brokers. And when you do this, depending upon who's paying the compensation, it affects either the basis or is considered a selling cost. So if the seller's paying it, it's a selling expense. The seller gets to deduct it from their taxes, only to the extent they're paying it. If you're buying it and you're paying commissions, you add it to your basis in the future. Of course, you're not selling the property right now, so you don't have to worry about the calculation. But in the future, you do add this to your basis. Recording fees, survey fees, transfer fees, title insurance, they're included in basis down the road. Excise taxes, though, and most generic local taxes, though, aren't deductible. A lot of people don't realize that. You have to take them out of your purchase price or your sale price. You're going to lose that money, but it isn't deductible as part of the federal calculation, typically. So then we get to the capital gains rates. And the capital gains rates are based upon your adjusted gross income. And most, not all, but most capital gains rates are going to be around 15%. It's a combination of your personal income plus the sale as property. So if you really look at the math here, you can have situations where you're at 15%, 20%, probably not zero, but it could in theory happen actually. And so you take the situation here and you figure out your taxable gain, and then you multiply it by your applicable tax rate, in this case 15%, and that's $37,500. Now, net investment tax is an additional bonus tax. It came around the Affordable Care Act. And I always have something called the Rule of 250. Once you start creating $250,000 of all-in income or modified adjusted gross income, you're going to start getting tagged with this. And because I'm in Washington State, when people sell properties in Washington State, they're often going to face net investment tax, which is 3.8% on their sale. So when I said earlier that, keep it simple method is to use 20% federal capital gains, oftentimes people are at 15%, but they're also triggering this net investment tax at 3.8. That's kind of how I create my sandbox to keep most situations in there, basically. So on $1 million sale, you take your selling expenses, so in this case $50,000. You take your long-term capital gains taxes, which we calculated based upon your capital gains rates around your AGI, and we figured out that you would get about $912,000 net federally from this. We didn't assume any net investment tax because $250,000 may or may not trigger that, depending upon the rest of your filing situation. We didn't look at excise taxes that may have occurred here, and usually 1% to 2%. In fact, a good rule of thumb is you lose about 8% between brokers' commissions and closing costs on the sale of a property if you use a broker. And I didn't subtract out the mortgage. Some people still need to pay off their mortgage when they sell their property. But this should also give you a fairly good overview that $1 million home sale situation, oftentimes the taxation federally is not massively significant. It's there, but it's not normally a massive significant piece to this. Some basic things to think about. There's lots of good online calculators if you're trying to figure out what you're going to get. So I would definitely look at using an online calculator. And almost all math are going to be based around, can you figure out your basis? The basis is really important. Your basis, once again, that's basically what you bought something for plus improvements. There isn't an easy way to avoid taxes on your home once you hit certain tax thresholds. You can't 1031 exchange a personal property as an example. Once a home value is big enough, and I'm in the Bellevue area, so it's not uncommon for $1.5 million to $2 million for a home sale. It's not uncommon for there to trigger significant taxation, and it can be really hard to avoid that and accomplish other goals. There are ways actually even avoid some of that taxation, but it usually hurts you, even though you're avoiding the taxes. It's a net negative. So in general, it's hard to avoid the taxes once you trigger them. And if you look across the United States or even the state of Washington, most people are going to pay minimal taxes on the sale of their primary residence because of the $250,000 per person deduction you get. That really just wipes out the majority of this oftentimes. If you ever have questions about this, sale of property, or just general financial planning experience, I'm always out here to ask questions too. I love what I do. If you want a personal financial planner in your life who's trying to act as a personal representative and not just a phone relationship, I'd love people to reach out to me and interview me for that. But beyond that, I hope this was helpful and that this gives you good information on taxation of selling your home. Thank you.